Hello everyone, Professor Christensen here. So this video is going to give us an overview of Chapter 2. And Chapter 2 is one of the most important chapters that we're going to study. It builds on Chapter 1 and it gives us the foundation of the accounting cycle. So we have learned about the financial statements. Now we're going backwards. And we're going backwards to see how does all this information get into a place where it can be put into financial statements. And that's what we're going to look at now. So we're going to look at how all the things that happen every day get summarized into all the numbers like the ones that we used for financial statements. So our learning objectives for this chapter are to identify the basic steps. So we're going to look at the steps in measuring external transactions, so transactions with other companies. And then we're going to look at how those transactions affect the accounting equation. We're learning about debits and credits in this chapter. And debits and credits are tricky, but they're doable. So we're going to talk about the best way to approach debits and credits. Then we're going to look at recording transactions in a journal. From the journal, we post them to a ledger. And then finally, we prepare a trial balance. So you could see already, there's a lot of new words in this chapter, right? So focus in the first couple of chapters on the vocabulary. That's going to help you to understand everything that's going on and help you to have a better handle on all of this. So for chapters 1, 2, and 3 have a lot of vocabulary. All right, so first thing we're going to look at is this whole process of measuring external transactions. So we start with source documents, and that's a document that says, okay, something happened that needs to be recorded. Then we look at the impact of that on the financial statements. We decide, is it a debit or a credit, or which accounts are being debited and credited. Put those debits and credits into the journal, post them to the ledger, and then finally prepare a trial balance. So these are all of the things we're going to be looking at in each of those learning objectives we just mentioned in this chapter. So I want to just mention source document. So source document, like I said, that's the thing that starts the whole process. That's the thing that says, well, a transaction happened. And in the old days, source documents were paper. And in some cases, they may still be paper. So for example, if a plumber comes to your house, it's possible he or she might give you a piece of paper or an invoice that says, here, this is what I did today. This is how much you paid for it. Or some other workers might be using paper. For the most part, source documents are electronic now. So it could be an invoice. So maybe your business bought something from another business. That would be an example of a source document, a common one. And one that you can probably relate to is a cash register receipt, right? So if you go into a store and buy something, that cash register receipt is a source document, and the summary of all of those transactions that happen during the day are going to go into that company's accounting records. All right, so this is what's called a chart of accounts. Again, some new words. A chart of accounts is simply a list of accounts and their numbers. That's all of the accounts that a company has and their numbers. So here are the accounts that this particular company has. And most companies number their accounts in this order. The assets begin with 100 or number 1, liabilities 2, stockholders' equity 3, revenues 4, and expenses 5. And you'll see, so the chart of accounts is in this order, and so is the ledger, and so is the trial balance. So this order is something that you want to remember. Assets, liabilities, equity, revenue, expense. Okay, so remember, a chart of accounts, just a list. Notice there are no numbers here other than the actual numbers of the accounts, and that's what the company uses to put input into its system to tell the system what they're debiting and what they're crediting, right? They're not going to be typing words in to debit and credit in real life, okay? All right, so next up, now we get into the hard stuff, all right? So this step 2 and step 3 are the ones that are going to require you to do the most thinking. So let's focus now on analyzing accounting transactions. By the way, I forgot to mention to you, I'm working on a video, Accounting with Accounts, that will go over, it might be more than one, they're going to go over each of what the accounts mean. So just so in case you're not sure what the accounts are and what they mean, take a look at that video. I'll send it around once I finish it. All right, so there is a video called Analyzing Accounting Transactions. This is one of the trickiest parts of this chapter, is analyzing the transactions. Okay, so definitely take a look at that. So what are we doing? Well, remember the accounting equation. The accounting equation is assets equals liabilities plus stockholders' equity, right? And so what we want to do is look at something that happened in the business and say, how does it affect this accounting equation? All right, so the assets equals liabilities plus stockholders' equity is kind of like a condensed equation. Now we're going to expand it a little. Remember, do you remember what's in stockholders' equity? Well, stockholders' equity is fairly easy because stockholders' equity for right now only has two things in it: common stock and retained earnings. Okay? Now, common stock comes from stock that was issued to investors. So investors put money in the company and they got shares of stock. Remember, retained earnings is income that has not been paid out in dividends. So retained earnings has three pieces: revenues, expenses, and dividends. Revenues increase our net income, so that increases retained earnings. So if you have a revenue, it increases retained earnings, which means it increases stockholders' equity. If you have expenses, remember, expenses decrease net income, so that expenses decrease net income, they decrease stockholders' equity. And then finally, dividends. Well, dividends decrease retained earnings, because remember we said retained earnings are earnings or net income that has come into the business and not been paid out in dividends. So dividends decrease our retained earnings, so that means dividends also decrease stockholders' equity. Okay? All right, so now we're going to look at debits and credits. So a debit and credit is a way of recording an accounting transaction. Remember assets, remember we keep coming back to this, right? This is going to be your BFF. Assets equals liabilities plus stockholders' equity. Debits equal credits. Left equals right. So take any ideas you have in your head about debits and credits, whether they're good or bad, whether it's money going in, money going out, something coming in, something going out. Forget all that stuff. Forget that stuff. Those are the things that get students bogged down with debits and credits. Debits are left side entries and credits are right side entries, period. That's it, okay? A debit is a left side entry, a credit is a right side entry. All right, let's see how they work now. This accounting equation, that can help you with to remember debits and credits, because debits are on the left, and this is called a T account. You can see why it looks just like a T. Debits are on the left, credits are on the right. Assets equal liabilities and stockholders' equity. So assets have debit balances, liabilities and stockholders' equity have credit balances. These are called normal balances. Now, remember our revenues, expenses, and dividends. So revenues increase stockholders' equity. Remember, we just said stockholders' equity has a credit balance, right? Revenues increase stockholders' equity, so they have a credit balance. Expenses and dividends decrease stockholders' equity, so that means that they are going to be on the other side, and they are debit balance accounts. All right, so let's look at this. This is going to help you to remember normal balances. And I know over the years, I've seen this written on a lot of students' test papers. So I know that it's a helpful thing to remember what is a normal balance for an account. So if you remember dealer, and the DEA is on the debit side and the LOR is on the credit side. So dividends, expenses, and assets have debit balances, normal. And we're going to talk about why that's important, but that's very important, the normal balances. Dividends, expenses, and assets have normal debit balances. Liabilities, equity, and revenue have normal credit balances. All right, why is this important? Well, this is important because the normal balance tells you how to increase that account. So an account with a normal debit balance is debited to increase it and credited to decrease it. It doesn't mean that if you have a normal debit balance account that you're always going to be debiting it. That's a mistake that sometimes students don't understand. If you have an account that has a normal debit balance, you debit it to increase it, but you may also be decreasing it. If you want to decrease that account, for example, if cash is an asset, right? If you're spending cash, you have to credit it. All right, so on the other side, it's the opposite. Liabilities and equity and revenue are increased by credit accounts and they're decreased by debit accounts. By debits, I'm sorry, not accounts. They're increased by credits and they're decreased by debits. Okay, so this is why I said to you that these two are a little bit tricky. So the analyzing, spend the time on the analyzing and on the debits and credits, because the rest of it is rather mechanical, and once you understand the mechanics, it's fairly easy. But the places where you're more likely to go wrong are the analyzing and debits and credits. Now, this is why it's a little tricky to learn debits and credits. You have to make all of these decisions before you decide whether to debit or credit an account. So you're going to ask yourself, what accounts are affected by this transaction? And we're going to look at an example in a minute. What accounts are affected? There's going to be at least 2 accounts because there's always at least one debit and at least one credit. There could be many debits and many credits, but there has to be at least one of each. Then you need to decide, are they increasing or are they decreasing? What are their normal balances? Is the normal balance a debit or a credit? And then that helps us to decide, should we debit it or should we credit it? All right, so here's a little hint. Remember that if you're sure of one of them, if you're positive, in this case, I'm definitely debiting cash, and I know that common stock is involved, then you know you must be crediting common stock, right? So remember that one can be kind of like a little crutch to help you learn the other one. All right, the only way to learn debits and credits is to practice. And I have seen this, I've been teaching for a very, very long time, and I've seen this in the classroom over and over again. The more you do it, then what happens is it becomes automatic. It's like, think about driving a car. When you first drive a car, if you've driven a car, the first time you drive a car, there are a lot of different things involved. After a while, those things become natural. And that's probably anything that you do. If you play a sport or all the things that you have to think of very carefully at the beginning, after you practice a long time, they become natural. But the only way to do that is to practice as much as you can. So you have your guided notes, and of course you're going to have your assignment also. And remember, there's additional resources that you can use. There's 2 related videos here. One is called Debits and Credits, and that kind of goes over the debit and credit thing again. And one is Practicing Debits and Credits. Okay. So next up, remember I said those are the 2 hardest. Next up is recording them in a journal. So once you've decided your debits and credits, you've done the hard part. Now we're going to record it in a journal. But you do have to understand, what is a journal, okay? So a journal is a list of every single transaction that happened in a company in chronological order. So every single thing. Now, I don't mean every single sale. So remember before we talked about, well, let's say you go into a store and you buy a shirt and you give them your credit card or cash, and say you pay $50 and you get your shirt, right? That's one transaction. That store is not going to record that individual transaction. At the end of the day, the store is going to take all of the transactions for the day, put them together in a total, and then they're going to make one entry for this. So by every transaction, I don't mean every single thing that happens, but they're like summaries, right? So, so here's what a journal entry looks like. So the journal is, let's look at the vocab here so we don't get confused. The journal is the document or the record of all of the transactions in chronological order. And what we're looking at here is a journal entry. This is a journal entry. So every journal entry has a date. It has the name of the account that you're debiting, along with the amount that you're debiting. And it has the name of the account you're crediting along with the account that you're crediting. The name of the credit account gets indented. All right, and that kind of tells the reader, okay, that's a credit. So remember, there has to be at least one debit and one credit in every journal entry. The total dollar amounts of the debits has to equal the total dollar amounts of the credits. All right, debits have to equal credits. All right, so now once you know the debit and credit, the journal part is fairly easy. After you do one exercise with journal entries, you're going to be good at it. It's not the kind of thing that's going to take you a really, really long time. So journal entries, practice them a little bit, and those will come natural to you. Remember the hard part, which is the analyzing and deciding what to debit and credit. All right, so let's see how this looks. This is an example. They sell shares of common stock to investors for cash for $25,000. Now, when you're analyzing transactions, look for words to help you, right? In this particular case, the accounts are in the description of the transaction. That is not always the case, but in this case, the accounts are here. What are the accounts? Common stock, cash, right? Common stock and cash. And here's our amount, $25,000. So we have to decide which one's going up and which one's going down. And what happens is our cash goes up, right? Because investors are putting money into the business, so the business's cash is going up. Now, we have to decide what two accounts. We decided those. Which are they going up or going down? Well, cash is going up and common stock is also going up because common stock goes up when investors put money into the company, new money. So cash is going up, common stock is going up. Cash has a debit balance, so that means we are going to debit cash. Now remember what I said, we know that we have to credit common stock, but why are we crediting common stock? Because common stock has a credit balance and it's going up. So that means to increase it, we credit it. So we're going to debit cash, we're going to credit common stock. Remember, that's the tricky part. Now we're going to plop it into a journal entry. No problem. Debit cash, credit common stock, right? The debits go first and the credits go second. So if you had 5 debits and 2 credits, put all your debits first and then put your credits after that. All right? At the bottom of the journal entry, we have a little description. That's not always there in real life, but the description does come in handy for you now. Because it helps you to remember what you're doing, right? And helps to solidify that idea in your head. All right, so that is a journal. And remember, there are hundreds, thousands, millions of those, depending on the size of the company, in their journal every week, month, year. All right, so we are up to posting. So we did the journal. Now we have the journal, the list of all of our accounts. But let's think about this. Let's imagine a journal with all of these items in it. Well, what good is that if we want to know how much cash we have, right? You would have to go through a journal, which remember could have millions of transactions, and figure out, well, cash went up 25,000 here, and then cash went down by 2,000 there, and cash, that's not possible, right? So the posting process helps us to summarize all of the journal entries into what we call a general ledger, okay? So post, so we're going from the journal and we're posting to the ledger. All right, so this is what a real typical ledger looks like in a company's records. It would have a title, it has a date. It may or may not have a description, but it's going to have some kind of a reference, so you can reference the entry, the journal entry to the ledger and the ledger back to the journal entry. It's going to have a debit, a credit, and a balance. Now, for our purposes, we use this little T account. So we're kind of taking this little piece of this and using that instead of all of this, because this is a lot to write every time we have debits and credits. So we shorten our ledger and we make our ledger into a T account. Okay, now let's see. So what are we doing? We have one location, so the ledger, one location, and it has all of the accounts, and each account shows all of the debits and credits and the balance. The ledger has all asset, liability, and stockholders' equity accounts, and they're in financial statement order. Remember I said that financial statement order comes back 3 times. It's in the chart of accounts, and now it's in the ledger, and then next it's going to be in the trial balance. So financial statement order is assets, liabilities, equity, revenue, and expense. And the assets are in order of liquidity, just like they are on your balance sheet. So you start with cash, and then you would go down to your less liquid assets. Okay. All right, so let's see what the posting process looks like. So here are this is our T account ledger. So here are a couple of accounts. We have equipment. Well, equipment doesn't have anything in it yet. and we have a cash T account, and it looks like we had 2 transactions that increased cash. Well, this one, because this is the same example, this one is the one where they issued stock, right? So they issued stock and cash went up, and that was posted into our cash account. And then we had another transaction where we increased our cash by $10,000. Now, the current transaction that we're going to be posting is they purchased equipment with cash. So what happened? Our equipment went up. So in this case, 2 assets are affected. Equipment is affected and cash is affected. So our total assets are not affected because they're both going up and going down. But our individual assets are affected. So equipment is going up, and remember, assets have a debit balance, so we're debiting equipment and crediting cash because cash is going down. So we made that journal entry. Now all we do is we take our debit and we put it as a debit into the account that's being affected. So remember, I said this is mechanical, and you're only going to do this a couple times just to learn how this works. You'll see even in your assignments, in our general ledger assignments, this is done automatically for you. And in real life, you push a button and you say post, and the computer posts for you. But we do want to understand the flow of information, how things get from one place to another. So, and listen, if you're an accounting major, obviously it's very important. If you're a CIS major or anything to do with technology, you're going to be seeing this stuff and you need to understand it, right? Because if you're trying to work on something to do with accounting information, it's extremely helpful to know how the stuff gets where it's going and what the flow is. So here we are, 24,000 debit goes into our equipment account, 24,000 credit goes on the credit side of cash. And here's our balance. Our equipment is easy. Now let's look at what happened with cash. So when you have a balance, the balance is shown on the side of the normal balance of that account, or where the biggest number is. So here we have increase of 25,000, increase of 10,000. So we $35,000 of increases minus 24,000 of decreases, which gives us a balance of 11,000. That is written on the debit side because it is a debit balance, right? If you have a cash account that has a credit balance in this class, then you have a problem, right? In real life, it is possible to overdraw an account, but not in this class. You're not going to see overdrawn accounts, all right? So that is the posting process. So our last thing is a trial balance. And what a trial balance does is it summarizes all of the general ledger accounts. Again, it's in financial statement order, as I mentioned a couple times. And this is what our trial balance looks like. It has the name of all of the accounts in order, and then it has the balance in the account. This is a document that is used a lot by people in a company, because if you want to know, for example, how much your accounts receivable are, you don't want to have to go to your ledger. You have this trial balance, and it's very handy. It's got every list of every account that you have. So your debits go on the debit side, your credits go on the credit side. And notice this, very important, trial balance, like a balance sheet. Remember the balance sheet, your total assets equaled your total liabilities plus your stockholders' equity. Notice there are no words like that on. Sometimes students get trial balance and balance sheet mixed up. Notice there are no words like asset, liability, equity here. None of those. It's just a list of accounts. But the thing that the two balances have in common, balance sheet and trial balance, is that they have to equal. So at the bottom, here you have the 44,002 on both sides. If your trial balance doesn't balance, let me tell you from experience, look at your retained earnings. All right. So finally, let's just review this whole process. We started with source documents. And let's say that we had a store, had a transaction. You went in, you bought a shirt, you gave the money. And then you analyze it. Okay, well, for that particular transaction, cash is going up, revenue is going up. So if we increased our cash, we increased our stockholders' equity. We were debiting and crediting. So for this case, we would debit cash, credit sales revenue. Okay. We post it into the journal. So we put our debit to cash and credit to sales revenue into our journal. Post it into our ledger, our two T accounts, the one for cash and the one for sales revenue. And then finally, we add that to all of the other transactions and we prepare a trial balance. Okay, there are two videos called Accounting Cycle Part 1 and 2. The only thing with those videos is that, excuse me, they do show some of the items that we're going to be dealing with in Chapter 3. So you may want to watch those. If some of it's a little bit confusing at the end when we look at adjusting entries, you can put that away till the next chapter. I think you have enough to get you through here, okay? All right, so please make sure you watch those other related videos. I think they're going to help you with a lot of these topics. And you may want to go back through this video because I did go very quickly so that we're not spending too much time. I got in about 25 minutes, which is good. And good luck studying. And as always, please get in touch if I can help you with anything. Happy studying.